Hello everyone, welcome to this session. This session will have a look at the very important very important fund type that is known as a private equity fund. Now we in the previous videos we have seen mutual fund, mutual funds and hedge funds. In this session we'll look at what is a private equity fund and how typically a private equity fund works. Now a private equity fund similar to all collective investment scheme, it works like where there is a fund manager. The fund manager will collect the investments or a pool investment from various investors, invest in the market, and what the return which is generated is passed back to the investors in the form of distribution. Now, like hedge funds and mutual funds, private equity funds is also a collective investment scheme. However, the private equity funds works in little different way and they have some different characters. So, in this session, we will look at what is a private equity fund and what are the typical characters of a private equity fund. Now, when I say private equity, the word private and equity means it's a separate investments. So, how a private equity fund works, right? The private equity funds do not invest in equity, do not invest in equity or bonds, but what they do is they take equities or in private listed companies or unlisted companies. Now, let's look at some of the characters or features of a private funds. First, a private equity fund is not offered to the general public. In the sense like a mutual fund, the private equity funds are not offered to the general public. Instead, it is offered to accredited investors or high net worth individuals. HNIs and institutional investors like domestic institutional investors or foreign institutional investors are primary invest in the private equity fund. That is one. Most of the private equity funds works on a LLP model, that is limited liability partnership model, where we have a fund manager or an investment manager basically who manages the fund is called as a general partner, and the investors in a private equity fund are called as a limited partners. Now, last one is the types of investment. When I say types of investments, right, basically they invest in a P in the sense it's a private equity. Private equity normally in a listed company. For example, let's say we have a company called Reliance Industries in India, and a private equity fund, for example, let's say BlackRock private equity fund buys about like 5% of stake in Reliance Industries. Now, this is known as a private equity investment. Second is VC. V is like a venture capitalist. So, basically these are the investments which are done in the startups. So, when the startups are very new, startups are very new and they are in their early stages, they invest the investments which are made, which is called as a venture capitalist. Third is it can be a private debt. Now, very similar to the bonds, what happens here is the company provides or lends money to the private equity funds lends money to the companies. So, this is known as a private debt. And the private equity funds, they invest in real estate. It can be in a residential real estate properties, or they also can invest in commercial real estate properties. So, these are some of the characters of a private equity funds. Now, what are the key features? The key features of a private equity fund, one, they are closed-ended mutual. So, basically this works as a closed-ended fund. Now, unlike mutual funds which can be open-ended and closed-ended, all private equity funds works on a closed-ended basis. Means they are not they open and they operate for only for a certain number of years. Usually about 10 to 15 years is the total lifespan of a private equity fund. Investments. Unlike mutual funds and hedge funds who invest for a shorter period or shorter period of time, the private equity fund do not invest for a shorter term. They invest for a longer term. Usually the investments done by the private equities last minimum of 5 years to 10 years. So, typically the investment horizon here is longer period. Third, unlike mutual fund hedge funds, the investors do not buy units over here. Instead, how it actually works is the private equity has investors, and the investors who are known as limited partners, they commit certain capital, and this capital is actually they invest this capital in a period of time. Now, let's have a look at how this capital process works in a private equity fund. Now, let's say for example, we have a BlackRock. We have BlackRock private equity fund. Now, this has 4 investors. Let's say investor A. So, we have investor B and we have investor C. Now these investors are called as a limited partners, or they are known as a LP. So these are known as a limited partners. Now the BlackRock, the fund manager, here it is called as a GP. GP in the sense it is general partners. Now let's say how the capital process works in a private equity fund is, the investors commit certain capital. Let's say for example, investor A commits about like 100 million, investor B, he commits about like $100 million, and investor C, he commits about like 100 million. Now totally in the fund we have 3 investors, each one of them are committed about like 100 million. Now let's say for example, what happens is they find an investment opportunity. Let's say the BlackRock finds an investment opportunity. Now to invest in this fund, they need about like $90 million. So what will happen is the general partner, who is a investment manager, will approach the investors and they will ask them to submit and ask them to invest in capital. Now this, all the investors are committed about like 100 million. Out of that we require 90 million. So taking this example, each investor here will contribute about like 30 million. So this process is what we call as a capital call process. So in a private equity fund, unlike where mutual funds or hedge funds where they buy and sell, where they normally they buy units, here the investors do not buy the units, they will invest in a tranches. Means as and when the general partners call for the capital or investment managers call for the capital, the limited partners or investors will invest. So this is how the capital call process is done in a private equities. Next one, illiquid instrument. Since the investment horizon is longer period, typically ranges from 5 to 10 years, the investments which are done are normally has a very low liquidity. In the sense they are illiquid assets and it takes about like 5 years or 10 years for them to generate the return. And very important period, because private equity funds are structured as a LLP, there is something called as a LPA, means limited partnership agreement. So limited partnership agreement is basically, it's like a partnership agreement between general partners who are investment managers and the investors, and it talks about like how the investment should be done, what are the terms and conditions which need to be followed by investors as well as general partners. Those will be mentioned in the LPS, that is limited partner agreement. Now every investor who are investing in the private equity fund have to sign and they have to sign a formal LPA and return back to the general partners. Now typical some of the types of private equity funds are like, first one we have a real estate. Now this the fund which is run by, called as a Brookfield private equity fund run by KKR. Now these are typically a real estate fund, in the sense this real estate fund mainly invest in commercial residential properties, like they invest in offices, they in creating infrastructure, they work in, they invest in such in. The second one, one example is a private debt. Now how does a private debt works? So let me give an example how a private debt works. Let's say for example, we have a company. Let's take for example, the company name is Tata Steel. Now Tata Steel requires about like $100 million. So they require about $100 million. And one way they can do is they can issue equities or they can issue bonds. But what happens, right? The third way how a Tata Steel can raise this 100 million is they can approach a private equity fund. Now, for example, let's say there is a PIMCO private equity fund. So they approach the PIMCO private equity fund and the fund will lend $100 million. So they will lend $100 million. Let's say for example, at the rate of 8% per annum. So typically they lend at 8% per annum. This type of agreement or this type of lending money to a companies we call as a private debt, because this is done through a private arrangement. So this is an example of a private debt. Now third important thing is private equity. Now private equity very similar to the private debts. Now let's have a look at that, how a private equity actually works. Now let's say for example, I have a company called Reliance. Okay, we have a Reliance Industries. Now Reliance Industries need about, let's say about like they require about like $50 million. Now there is a private equity fund. Let's example, we call this as a Bridgewater's private equity fund. So what Bridgewater's private equity fund is, they will invest about like 50 million. Let's say for example, Reliance Industries give them, Reliance Industries provides, or Reliance Industries allocates 1% of equity. So totally they allocate 1% of equity, and typically what happens is Reliance Industries are raising 50 million of capital by issuing 1% of their equity shares to Bridgewater. So this type of investments, we call this as a private equity investments. The last one is venture capital. As I mentioned previously, venture capital is usually the capital which is provided to the startups in the early stage. We call them this as a venture capitalist. So these are some of the types of private equity funds and some of the examples of them. Now let's have a look at that one, how the private equity funds are structured. The private equity funds like hedge funds are mainly structured as a LLP. Now they have a variety of models. One is, we call this as a Delaware or a Cayman limited partner structure. So this basically works like a master feeder structure where they create one hedge fund which is called as a master fund, and master funds are used for investments, and they create multiple feeder funds which in different geographic locations, and these feeder funds are used for collection of used for capital calls and distribution purposes. So this is one type of structure we can create. So that is known as a Delaware or a Cayman structure. Basically, it's very similar to master feeder structure of a hedge fund. Examples of some real life examples, you have a Blackstone fund which is about like 26 billion in AUM. Main strategies, they do a buyouts, means buyout in the sense they invest in they buy considerable stakes in the listed companies or unlisted companies. So basically this works on a master feeder structure, and they follow a fee of 2% to 20. 2% means 2% of management fees and 20% of performance fees. This is one structure. The second is what we call as a onshore fund, onshore model, offshore model, or what we call as a parallel model. This is very similar to side-by-side funds, which, hedge funds, which we discussed, where there are two types of funds. Two funds are created. One, it is used for domestic investors, and one it is primarily for foreign investors. So let's look at some of the example of a parallel fund. Is one created by name Carlyle Fund Manager. So the fund size is about like 13 billion, and basically they use for buyouts, and they have two funds, one for the domestic investors and one for the foreign investors who want to avail tax exemption. And these funds also follow a dual fee structure, that is 2/20 fee structure, 2% of management fees and 20% of performance fees. The third type of fund which they can create is it works on a segregated model. Segregated models is the fund will have multiple classes, and the one important feature of a segregated model is they allow for co-investment. Now let's understand what is a co-investment. Now let's say for example, let's say I have a fund called PIMCO Private Equity Funds. PIMCO PED fund, and this is about like 500 million in capital. So this fund is about 500 million capital. We have three investors: investor A, investor B, and investor C. Now let's say this PIMCO Private Equity Fund, they invest in a company called as, for example, let's say they invest in HDFC Bank in India. So they invest in HDFC Bank. Let's say for example, they buy about like 5% of stake in HDFC Bank. Now, what is co-investment? When I say co-investment, right, what do you mean by, what is the meaning of co-investment is, if any of the investors who want to invest additional capital. Now, let's say for example, this 5% stake, each one of them have provided about like $75 million. Let's say for example, each of them invested about like 75 million in that total of 5% stake. Now, let's assume that if the investor A, he want to invest an additional 25 million, okay, he want to invest an additional 25 million, he can invest in HDFC Bank. Means the basically the investment which the private equity fund is done, This investor, if he wants, if he is vicious, he can invest additional 25 million. This type of investment is what we call as a co-investment. So this does not come under direct investments. We call this co-investment because this is over and above what investor A has initially invested. Now let's understand fund cycle. So what is basically the fund cycle means? A private equity firm, the time it starts, it's created, and the time it actually winded up, it actually goes through a frequent of stages. So those stages we call this as a fund cycle. Now the first stage of a fund cycle is fundraising. So typically what happens is the fundraising goes about like 6 to 12 months. What happens here is the fund manager will approach the prospective investors, explain about the private equity fund, what is its features, what is the investment opportunity, etc. And they will they'll persuade the investors to invest in the fund. So this is fundraising stage. The second stage is a investment. So once the private equity fund raises the sufficient funds, they will invest. The investment period lasts about like 1 to 5 years. Let's say, for example, the fund creates in 2021. They take about like 1 year to collect the funds. In the year 2022, they'll start investing. So as I mentioned before, the private equity funds have a longer time horizon. So it takes about like 5 years. Let's say after 5 years, they keep invested in the 5 years in a particular investment. The third stage is harvesting and exit. Harvesting and exit, right? These private equity funds make variety of investments and slowly they start returning back, or they actually exit from the companies. So that is how they can generate the return. So this stage is called as a harvesting or exit stage. And finally, we have winding up stage. Winding up stage is once the private equity fund have achieved all its investment objectives. Let's say they want to operate for 10 years and they want to generate about 30% of the return. So once this objective is achieved, the fund will actually finally wind up. So these are the 4 stages of a fund cycle. Okay, so basically talking about this in this session, we spoke about what is a private equity fund, what are the various structures of a private equity fund, and what is a typical cycle of a private equity fund.